Welcome to the StockOptionAssassin.com's free trade of the week. My name is Eric. Let's take a look at the markets. Today is Monday, January 13th. We're about 2 p.m., so we got a couple hours until the close. The market, I'm looking at the SPX here, starting to kind of pull back a little bit. I was waiting to see what would happen this week, if we were going to push up. It is January options expiration, which typically you're going to have kind of a neutral bias. So it'll be interesting to see actually how much selling we could get. Now we could very well dip in the next couple days, which anything down to about 1815 on the SPX I think is a buying opportunity. You could possibly sell some spreads down there on strong stocks wherever they're hanging in there. But the trade we're going to look at today is a calendar spread, and I'm looking at doing it on the SPX. And I want to first kind of go through quickly what the setup is. So first of all, you can notice I don't really have any indicators on here, moving averages or anything. I strictly am using implied volatility. And the other thing we have is that we have about 38 days left until February options. So these are the two main criteria for this trade. Is I like doing it on indexes. I like the implied volatility to be low. Let's look at that. So we have an implied volatility here on the chart. You can see this is the range of the past year, and we are at the lower part of the range. And a calendar spread makes money with a low volatility, and as volatility increases, calendar spreads can make money. Now today, the SPX is actually pulling back a little bit, so you can see the volatility is sort of picking up a little bit. So I don't want to enter this trade today, but I will be looking at entering this trade potentially in the next couple days. So we'll be doing that with our service. So if you're interested in that, go ahead and go to the website, start the trial if you want to get more information on this. We actually have a full 30 to 45 minute video course on this exact setup if you're interested in that. But the other sort of parameter of the trade is the amount of time left. So we all know for the most part that once we get down to about 30 days left, the theta or time decay of the options start to decay faster. So what we're trying to do is take advantage of both an increase in volatility and theta or time decay. So what we're going to do is a calendar spread is the same option, and we're going to use call options, and we're just going to price one out real quick. Right now, the at the money option, this is what you usually do, is at the 1830 because the SPX is trading at 1829, so it's slightly out of the money. So if I right click this and I'm going to buy a calendar spread, you can see what the order brings up here. So what we're doing is we're selling one February call and buying one SPX March call. So the difference here is the time. So in the last 30 days, the time decay is faster. And during for March, we have 66 days, so there's still some time decay, but it's not nearly as fast. So what you're looking to do is take advantage of this call option decaying faster than the one you purchase. Now, for the calendar spread, it would be a debit. Right now, it's going for almost $10. And let's take a look at the risk profile. I'm going to right-click that trade and go Analyze Duplicate Trade. And you can see basically what happens, this little tent gets formed. And what we're looking at is as long as the SPX stays between the break-even 1800 and 1860, this trade will make money over the next 38 days until that expiration. Now, we don't want to hold this through because remember, this option is going to expire. Now, typically, what we're looking for is a 15 to 20% gain in about 2 or 3 weeks. And our stop loss is also about 15 to 20%. So again, we're looking to pay about $10 so per spread. So if we bought this spread for $10, we'd be looking for a gain of about, looking to get rid of it for about $12 and a stop loss at about $8. So that's kind of the setup. As SPX sort of chops around here, this white profit line is going to slowly start raising because of volatility and also because of time decay, and that's when we look to take our profit. So this is sort of a monthly income trade we try to put on typically around expiration week, and we look for the options the next month out, but also that implied volatility needs to be at that lower scale. So hopefully that helps. You guys have a great week, and we'll see you at the next update.